All right, welcome everyone. Thanks for those who have already joined. I think there will be a few more coming in the next minutes. So I will give you a short introduction and a presentation of Michael Mauboussin. In the end, there will be time for Q&A, and participants will remain on mute until the Q&A session. And also for your information, this webinar is recorded. So good day, everyone. Good morning, Michael. Decisions, books, mental models, complex adaptive systems, skill, luck. These are the tag words Michael Mauboussin is using in his Twitter profile. What is their common denominator? You may have guessed right. This was in the bio of Michael Mauboussin, but also the ingredients of an investment process, whether successful or not. This brings me to today's topic, debunking 5 investment myths. And no worry, there's no quiz in the end, but you can access the slides afterwards in the member section of our website. So we are very pleased today to have Michael Mauboussin as a speaker, and a few words on his career. He started as a packaged food industry analyst at Credit Suisse in 1992 and was named Chief US Investment Strategist of Credit Suisse in 1999. Currently, Michael is the head of Consilient Research at Counterpoint Global in New York and was previously Director of Research at Blue Mountain Capital, Head of Global Financial Strategies at Credit Suisse, and Chief Investment Strategist at Legg Mason Capital Management. He also wrote 3 books, including The Success Equation, Untangling Skill and Luck in Business, Sports, and Investing, and is co-author of with Alfred Rappaport of Expectation Investing. I think it is safe to say that Michael has spent his entire professional life in the investment industry, and he did not go unnoticed, as Michael has been repeatedly named to Institutional Investors All-Star American Research Team and Wall Street Journal All-Star Survey. So I'm looking forward to an exciting and exclusive discussion for the CFA members. And in terms of process, as I said in the beginning and for your information, this presentation is expected to take approximately 40 minutes. You can submit at any moment questions via the Q&A tool, and we have reserved the Q&A slot towards the end of the presentations. A few questions have been sent prior to the session and will be treated as well during or after the presentation. And now, without further ado, I'm handing over to Michael in a minute to start the presentation. Bear in mind that it's very early in the year, and I'm glad that Michael could make the time this early. So thank you much in advance, and now over to you. Michael, you're on mute.
Thank you. Good day, everybody. It's great to be with you. Good, let me see. Let me bring my slides up quickly. So as Nick mentioned, I gave I was asked earlier this year to give a talk about what is a really interesting topic, which is some myths or popular delusions in the investment industries. And so I'd love to just I've selected 4 of those actually, and love to run through those with you today. And one has to do with the market's time horizon. Second is the idea of the contribution of dividends to total shareholder returns, investing in money-losing businesses, and finally the idea that indexing, the popularization of indexing may make it easier for active managers. So hopefully we'll touch on something that you believe, spark a little bit of controversy in your mind, and that will lead to a very animated and fun Q&A. So let me delve right into this topic. And that is, the first one's really the issue of short-termism. So this, I think, is a quote that very much captures the sentiment. This was done by Mark Wiseman and Dominic Barton, McKinsey, and a Canadian pension fund. And so they say the shadow of short-termism has continued to advance, and the situation may be getting worse. As a result, companies are able to invest and build, are less able to invest and build for the long term, undermining broad economic growth. So this is, by the way, nothing new. People have been complaining about short-termism as far back as you can go. For some reason, every contemporary generation thinks that they're doing things better with more I mean, they used to do things better in the olden days than they do today. So these concerns are age old. So this view, by the way, is wrong on a number of fronts. But before I talk about where I think it's wrong, let me first say that there may be some justification for thinking in slightly shorter time horizons. One example is the rate of change in our world. And this, I think, is one of very interesting ways thinking about the diffusion of technology. So this is how long it takes a technology to diffuse through half of the US population. You can see it took the telephone about 70 years to do that. It took the personal computer about 20 years to do that, and the internet down to 10 years. So new technologies that are interesting seem to be diffusing much faster, which means the rate of change is probably accelerating. Another interesting dimension, also arguing that we should be pulling our time horizons in just a bit, is asset lives. So as you know, when a company puts an asset on the balance sheet, typically the accountants say you have to depreciate that asset over some period of time, so they designate this asset life. And here's the average asset life for a dozen sectors. And the key observation here is if you go back to say like 1980, the average asset life was for the industry, for the market, something like 13 or 14 years. And if you do the market capitalization weighted asset life today, it's much closer to 7 or 8 years. So simply, if you're a chief financial officer, your time payback is not quite half, a little bit more than half of what it was just say one generation ago. Now that said, let's turn to the argument that the market is taking a very short-term oriented view, and that I think is something that we can demonstrate is incorrect. Now it's easy for people, first of all, just to say the market's overvalued. You hear lots of pundits talking about that all the time, right? They'll often appeal to things like the CAPE ratio, saying how high things are. That alone should give you pause if you're arguing for short-termism, right? Because high valuations means that the market is recognizing and paying for cash flows many years into the future. Just mathematically, that has to be the case. So if you're arguing that markets are overvalued, in a sense, you're arguing the very opposite of short-termism. But specifically, we drill down a bit, we could just say that stock prices reflect the present value of future cash flows and really ultimately the present value of future dividends. So one of the questions is, how much value am I getting for what I can see fairly closely in front of me? So here's a very simple exercise. I do this with my students at Columbia. We pick 5 blue chip companies from the S&P 500. We take their year-end stock prices, we take their dividends and project out and present value their dividends for the next 5 years and say what percent of the value is attributable to cash flows beyond 5 years. And you can see the average for our population here is about 90% of the value is beyond the next 5 years. By the way, you might say, well, they're buying back stock and so forth. Even if you throw that in the mix, it's still 80%, above 80% ratio. By the way, even at the lows of the stock market in 2009, so when things were really very dire, that number was still about 80%. So the market does acknowledge and pay for cash flows many years into the future mathematically. The other one I hear a lot is, and we hear this a lot from executives, is, we can't be long-term oriented as executives because the investors are so short-term oriented and they're just worried about quarterly results or annual results, and as a consequence, they're moving money around all the time. And that would tend to manifest in portfolio turnover. By the way, Michael Porter, the famous strategy professor, wrote a big report in the early 1990s talking about how turnover had accelerated so much and how that was such a big problem in terms of short-termism. By the way, so this is the actual chart of portfolio turnover since 1946. I don't know if you see a worrying trend about portfolio turnover going up. It seems like it's been going down, has been going down candidly since the mid-1980s, and certainly well off the peak of around the dot-com period. By the way, if you look at this chart carefully, you'll see that there's really the 1960s, by the way, or 50s and 60s, there were very high friction costs and very high taxes. But you see really there's a big point of takeoff here, and that was 1975. And that was the deregulation, of commissions. By the way, here's an interesting statistic for you. The cost to trade 10,000 shares in the mid-1960s, and by the way, commission costs were regulated. The cost to trade 10,000 shares was $40 43 cents per share, 43 cents per share for a $40 stock. So there were huge frictions going in. Of course, costs today are 99% lower than that for institutions. So broadly speaking, if you actually look at the market itself, you see the market's actually paying for the very long-term future. Now, one way you might get out of this is say, because investors, if they're focused too much on the short term, you might say investors make short-term bets on what are ultimately long-term outcomes. And I think that may be a valid statement, but the fact is the market is long-term oriented, and those companies that pursue sensible and credible long-term plans tend to get rewarded. Let me turn to the second topic, and that is on that of dividends and long-term returns. This is another one I always find surprising, especially if you just sort of go through the math. I've written a little bit about this in the past, and I had a conversation with a very seasoned investment professional, a guy been around for a long time, and he read it and he read it over and over. And he kept saying to me, I see your math seems right, but I still don't believe this. So here's the statement. This is one, you could take many of these things, but here's somebody that try to capture this idea. And they said, some may be surprised to learn that 90% of the US equity returns over the last century have been delivered by dividends and dividend growth. I would be surprised if that were true, because it's not true. So let's decompose that. And let me just start with a fairly maybe controversial statement, but I'm going to try to unpack that and try to persuade you of this point. If your objective is as an investor, and I think even if you're an investment manager serving your clients, if your objective is to accumulate capital over time, and I suspect many of you agree that is what you're trying to do, then price appreciation is the only source of investment returns that increases accumulated capital. Price appreciation is the only source of investment returns that increases accumulated capital. Dividends, in fact, play no role in this process. So let's unpack that a little bit. First, let's just talk about this concept of total shareholder return. This is the classic equation. You are CFA charter holders, or many of you are, so you know this. You had to memorize this at some point, right? So G equals price appreciation, D equals the dividend yield, and you can see there's a little multiplication term at the end to capture the role of compounding. Now, of course, if you own a stock for 1 year and you say, what was my return? It would be indeed the price appreciation and the dividend. Where it becomes a little trickier is when you start to say, I'm going to compound over time. How do I think about the role of dividends, right? So that equity return for 1 year would indeed be price appreciation plus dividend. But when we talk about geometric processes over time, you'll see that the math changes just a slight bit. So let's slow this down just a little bit. I probably should be doing this in euros or francs or something, but I do it in US dollars. So let's say you own a $100 stock, and they have a 3% yield. So they're going to pay a 3% dividend. On the ex-dividend date, you're going to end up, of course, with a $97 stock and a $3 dividend. Right, so those are the two pieces of 100. 97 plus 3 has to equal 100. To earn the total shareholder return, you must reinvest that dividend to return your capital exposure back to 100. So in effect, the bank is giving you the $3, and you must give the money right back to the bank. And then, of course, your capital accumulation depends on the price appreciation that you receive from there. Right, so ultimately your capital appreciation is a function of how much money you invest, how long you invest, so how long you're participating in markets, and price appreciation. Those will be the three things that drive value. Now, the other comment I'll make is, in our industry, we tend to spend a lot of time comparing returns, whether it's indexes or for stocks, to this concept called total shareholder return. But the reality is very, very, very few investors actually own the total shareholder return, right? Because for you to do that, you need to assume two things. One is you have to reinvest 100% of your dividends. And especially for people that own individual stocks, very rarely is that the case. Mutual funds, as you know, especially for you fund managers, dividends come in, you tend to put that into your cash balance and then just reinvest that. You don't put that money right back into the same stock that paid the dividend. And the second thing is there has to be no friction whatsoever. So there can be no taxes and no transaction costs. And there are some instances where that could be the case. There are some dividend reinvestment programs, and you can do that in a non-taxable account. But for the vast majority of the money moving around, that really isn't the case. So TSR becomes this almost impossible benchmark. By the way, Nick mentioned my co-author for Expectations Investing, my dear friend and mentor, Al Rappaport. If you're curious about this topic, you'll see the reference down below that Al wrote a paper in the journal Portfolio Management a little while ago that actually goes through this in some great detail. I'm going to add one bonus slide to this, to another area where I think there's monster confusion, and that is the idea of share buybacks. I'll try to do this as quickly as possible, but the main thing I want to emphasize is there's what I would call a value conservation principle that you can't lose sight of. So what that means is and just take on one of those, it's a very busy slide, but on the left, you'll see I have a company that I'm saying is worth $100,000, and let's just pretend it's cash. So we actually know the exact value, and they're going to pay out $20,000. Well, that means that the value of the firm after this disbursement is going to be $80,000, right? And it doesn't matter if they pay a dividend, buy back stock, or burn the cash in the parking lot, right? The value is going to be $80,000. That value is going to be conserved. Now, the first scenario we'll consider, I'll take a look at is a dividend scenario that's on the far right. And of course, everyone's being treated the same. There may be different tax consequences, but everyone obviously gets their proportionate share of this dividend. Where things I think get confusing for people is when you buy back stock that's either overvalued or undervalued. If you buy back stock that's overvalued, of course, what's going to happen is the selling shareholders are going to benefit at the expense of the ongoing shareholders. And that's going to be a dollar for dollar exchange. So the sellers win and the ongoing holders lose. By contrast, if a company buys back undervalued stock, the sellers lose and the ongoing holders win. So of course, that's what you want. If you have an executive team that's very astute and they think their stock is undervalued, you want them to buy back undervalued stock. So there is a value conservation principle, though, where there are winners and losers by definition that have to equal out in dollar sums. And I'll just mention one other very quick story. I was with some folks who, it's one of the largest mutual fund companies in the world, and they're very smart and their track record is terrific. And they said to me, you know, we love dividends and we really don't like buybacks and so on and so forth. And so we were talking about this in some detail. So I said to them, let me ask you a question. The stocks you own in your portfolio, do you believe them to be overvalued, fairly valued, or undervalued? And of course, they said, why we wouldn't ask it? Of course, we think they're undervalued. So I said, the surest way to create value per share is to buy back undervalued stock. There would be no reason for you to want them to pay a dividend, especially if there's any sort of friction. You'd much prefer them to return cash by taking out the shareholders that don't believe. That will increase your intrinsic value per share. So even that logic to me didn't make a lot of sense. Now they were thinking about signaling and other stuff, but that's interesting. The next idea is we should not invest in companies that lose money. And I sometimes hear this, and I even hear laments that, you know, I can't believe how many listed companies are losing money. Let me say at the outset, sometimes you should invest in these companies and sometimes you should not. So there's no right answer to that. But here's a little game for us to play this afternoon. Here's a profile of a business. Pretend that I have a perfectly clear crystal ball. And so everything I'm going to say here is absolutely accurate. The question is, do you want to buy the stock, right? So this company will be profitable for each of the next 15 years for sure. Sales and net income will grow at close to 40%. The company will initiate a dividend in year 3. They will grow that 50% compound annual rate through the end of the period. Sound good? Okay. Here's another company, another profile. This company is going to have negative free cash flow for each of the next 15 years. Again, that's absolutely sure to be true. The level of debt is going to swell at 34% compound annual rate. The cash balance, it will dwindle from 2.5% of sales to 2% of sales by the end of the period. Do you want to buy this? And of course, you know exactly where I'm going with this. This is the exact same company. It is Walmart from 1972 to 1986. That was the first 15 years that it was a listed company. By the way, had you bought Walmart stock, the answer to these questions is yes. You would have earned 29% compound annual rate versus 11% for the S&P 500. Now, the negative free cash flow, which you see on this slide, only says that the company invested more than it earned. The pivotal question as an investor was, what was the return on investment that they were making? And just to give you some sense of that, we estimate that that return on capital was in the high teens. So well in excess of the cost of capital, and of course, very value creating. So the big issue that we face today, interestingly, is that more investments, unlike Walmart, more investments are not tangible, but rather intangible. And as a consequence, they're showing up on the income statement rather than on the balance sheet. And when lots of investment shows up in the income statement, it's very conceivable that you would show companies that have losses that actually have very attractive economic returns. So back to basics, to value any business, you need to think about what the cash flows are going to be, when you're going to get your money, and how certain they are. DCF obviously is one way that can lead this discussion. What we know, just to give you some level set, is these are companies with negative net income in the United States back to 1980. Today, the numbers are right around 50%. You saw we had some prior peaks. One is around the dot-com period, which really was sort of a much looser, I think, environment than we see today. And then, of course, around the great financial recession in 1909, 08, 09. But you see we're at very elevated levels, and a very high percentage of companies are reporting losses. This is classic finance. Once again, you learn this in your CFA curriculum. This is thinking about what free cash flow is. That's the number on the far right. It's the pool of cash available for distribution to all the claim holders. It's the difference between NOPAT, net operating profit after tax, earnings, and investment, right? So earnings is derived primarily from the income statement. Investment is primarily on the balance sheet. And the point, of course, I'm emphasizing is over time, we've seen what we would classically consider to be investments migrate from the balance sheet toward the income statement. And I think that's clouded the picture in terms of our understanding. So let's talk about this measurement of intangibles. First, we'll start with the macro. This is tangible and intangible investments back to the mid-1970s. In the mid-1970s, you can see that tangible investment was not, and by the way, this is scaled as a percentage of gross value added, roughly basically GDP, private sector GDP. So you see that the intangible investments were roughly 2 times intangible investments in the 1970s. And today, intangible investments are estimated to be 1.5 times tangible. By the way, I should mention that many of the accounting rules were established back in the 70s and before, and I think they reflected a very different world. For example, specifically the rules on R&D in the United States for FASB in 1974, where they decided to expense all of that. Here's a bit of research that's completely novel. I find this to be very, very exciting. There was a paper you can see cited below by Luminita Nake and Anup Srivastava about whether intangible investments should be either reported separately or commingled with operating expenses. So what they did in their analysis is they said, let's take a look at the income statement. Cost of goods sold obviously is associated with sales, but SG&A, what component of SG&A is maintenance required just to keep the thing going, and what percent is in so-called investment SG&A. So I'll describe very quickly what they're doing is they take all of SG&A, they carve out advertising and R&D, and they say, we're going to assume that those are more intangible. What's left over is what they call main SG&A. That's why I see that term there. And they said, we're going to look at the component we believe is necessary to sustain the current business. And we're going to call that maintenance SG&A, main SG&A. And then the residual, we're going to call it investment SG&A. So they show those data back to 1970. We actually went to our friends at O'Shaughnessy Asset Management, their quants, and we asked them to update the data through 2019. So this data has never been presented before. And what I want to draw your attention to are the top 2 lines, right? So the first is you see that investment main SG&A, which had been rising steadily since the 1970s, albeit at not a great, super sharp slope. You can see the last 10 or 20 years has really advanced very markedly. And at the same time, you see this drift lower of maintenance main SG&A. So just to give you, again, some numbers to animate this, our estimate is that R&D for the US public companies last year was $425 billion. So that's that green line there, 425. CapEx, which is not on the chart at all, about 900 billion. And then investment SG&A, that high number you see there, about 1.8 trillion. So rough order of magnitude, investment SG&A is double that of CapEx. So when people lament about companies not investing and so on and so forth, they're very much, I think, missing the boat. Let me try to make this more concrete. I'm getting a little nerdy now. I'll do this quickly, but get concrete for one company, and that's Microsoft. I won't go into great detail on this, but let me just say there are 2 decisions you need to make. One is what items on the income statement, part of SG&A, will be capitalized. And for this, we use the work of Charles Holton, a very famous economist who's done a lot of work in this area. And the second, you have to pick an amortization period. So if you're interested in this, we published a piece yesterday where you can get more of these details. On the left is the classic definition of free cash flow for Microsoft. By the way, this is a spectacular business. So you can see pre-tax earnings of 56 billion, after cash taxes, $48 billion in net operating profit after tax. And then you can see different components of investment. So their investment, as you go down to 2020, fiscal 2020 is 10 billion for 2020. And then their free cash flow is 38 billion, right? So that's the classic definition. That's what I would teach my students in my business school class. On the right would include the adjustments, right? And so here's, as you know, going into this, what we're going to do is take a big chunk of those SG&A component, and we're going to allocate that as an investment, right? So it's going to go off the income statement onto the balance sheet. So I draw you down to the same NOPAT number 48, but now we're going to add the intangible investment. Last year was estimated to be 34 billion. We have to have an amortization period, so we have an amortization schedule. So the net intangible investment is 7 billion. So earnings go from 48 billion to 56, but there's a little bit of rounding, 56 billion, or about 15% higher. Right. So when people talk about these technology companies and concerns about multiples, what this analysis suggests is that the earnings are understated by some amount, in this case, roughly 15%. Now, of course, we have to reconcile this with the financial statement. So you see investment at the same time goes from 10 billion to 17 billion, right? So that $7 billion gets picked up there. So notice that free cash flow has not changed, right? Because the financial statements have to be what they are. But in our reallocation process, we've now shown that more money is going to investment, and in fact, profits are higher than previously anticipated. And we can do the same exact analysis with a return on invested capital. I'll spare you the details on this, but on the left, you see the traditional approach, and you can see if you go right down to the bottom line there that the ROIC for 2020 fiscal was 52%, which is fantastic. If we then on the right add back those investments onto the balance sheet, you can see the net capitalized intangibles is about $78 billion. And as a consequence, ROIC drops down to 33%. So it turns out that obviously invested capital grows very, very substantially from 96 billion to 174 billion, portraying a very different picture of the same company. Okay, let me finish up with the last of these, and that is that I hear from time to time that life would be easier, is going to be easier with indexers. And the thought process, well, here it is. Here's a great quote. This is from Seth Klarman, who, by the way, I deeply admire. I really enjoy being around him. I've learned a lot from him over the years. But here's a quote from Seth, and he says, indexing, or it could be rules-based investing, should give long-term value investors a distinct advantage. The inherent irony of the efficient market theory is that more people believe in it and correspondingly shun active management, and the more inefficient the market is likely to become. So that's the question I would pose for you is, if more people are basically punting by going into an index fund, does that make it easier, or are markets less efficient for those of us who remain? Well, I'll start with a Warren Buffett quote on this. And this is from his 1987 annual letter. As they say in poker, if you've been in the game 30 minutes and you don't know who the patsy is, you're the patsy. And of course, what we're trying to do here is think about who are the weak players and who are the strong players. So today is Thursday. Let's say I give you a call where I text you and I say, hey, I'm holding a poker game at my house tomorrow night, Friday night. I'd like you to come over. We'll social distance, of course, and all that. And presume that you like to make money playing poker. Your first question would be to me, who else will be there? And if I say to you, some really rich people who are really bad at poker, you say, I'll be right over, right? Because you can see where your source of returns are going to come. By contrast, if I say, hey, I've got players who are really good, they're probably better than you are, would you like to come? You'd say, yeah, I think I've got better things to do. So our poker analogy is as simple as it is, I think lays out three lessons that are really important, right? For every winner, there has to be a loser. Now in markets, that is not true absolutely, because if markets go up or markets go down, but it is absolutely true relatively, right? So on a relative basis. So the money coming in the poker room at the beginning of the evening and the money going out at the end of the evening is the same amount of money. So if there's a winner, there has to be shuffling. Second, the players in the aggregate will end up with less money if they pay to play. And in gambling, of course, paying to play is vigorous. Investing, that would be fees. And then finally, the rise of indexing may lead to fewer weak players. Why is that? Because, I'll posit this, right? Which is, might it be the case that those people who are leaving the poker game are the weak players? might it be the case that people who are leaving the stock market are the weaker players? And that means our job got a lot more difficult, not easier, because now we're competing against more skillful people. Now, from time to time, we hear things like, oh, you just wait for a bear market. That's when the active managers are really going to show their stripes or something like that. Well, as you know, also part of the CFA curriculum, Bill Sharp wrote a very interesting paper, 30 years ago about the topic of, it called the arithmetic of active management. And you all know this, right? The return on the average dollar managed actively will equal that of dollar managed passively, right? So let's just pick, I'm going to say MSCI World. You've got an indexers, which will earn the MSCI World's return minus a few basis points. And then we'll pretend that's the whole world. And then the active managers, of course, will also earn that return because the parts have to equal the whole, right? So mathematically, that has to be the case. And we're going to do all that before fees. And the second point that Sharp made is the return on the average dollar managed actively will be less than that managed passively because the costs are lower, right? And that differential is probably about 60 basis points. So just to be really clear, I'll make 2 points on this. One is indexers, just to be super clear, are free riders. Active managers do two things that are really important, and they provide societal good, which is price discovery and liquidity. So indexers are free loading on that. And second is, notwithstanding, I think as a high level, this is all correct. I don't want to get into an argument about the details of this. This arithmetic isn't precise because there are frictions like IPOs come into the market and rebalancing of indexes and so forth. So this is not perfect, but as a high level consideration, it's certainly right. As a level set, just here's some of the data on what's happened to active and passive. And here I'm picking up data really since the financial crisis, and you can see this has been a market acceleration. So you see about $1.8 trillion coming out of actively managed mutual funds, and you can see about $2 trillion going into index funds. So a market change. So the real question becomes, what does that mean for the complexion of those of us who are left in the active management community? Here we take a look at the distribution of alpha for large cap funds in the United States. This is just under 2,000 funds, so it's a fairly large sample size. And as you can see, it's not a perfect bell-shaped distribution, but a bell is not a hugely bad way to characterize this. The mean, by the way, is negative 80 basis points. The median is negative 40 basis points. And the standard deviation, which is the concept I want to dwell on now, is 7.1 percentage points, 7.1 percentage points. So going back to the poker discussion, if you're an active manager, what you want is a fat bell-shaped distribution, right? You want lots of positive alpha that's going to come from lots of negative alpha, right? That's really what you're after. So you want lots of weak players from whom you can win in this game. So in a sense, the thinness or the wideness of the bell-shaped distribution is an indication of the opportunity set for active managers. So let's take a look at that data going back over time. So the y-axis here, the vertical axis, is simply the standard deviation of alpha. So I want you to think of the y-axis as how fat the bell-shaped distribution is, right? So the higher the number, the fatter the bell, the lower the number, the skinnier the bell. And here's the trend that we see over the last, call it 50 years or so, 40 years, 45 years. You could see that that trend has come straight down essentially, right? And by the way, the number of funds is obviously much larger today. You see it's come straight down with one exception, that's around the dot-com period on this. Now, and maybe the second observation is actually, it's in the last few years, it's actually stabilized to some degree. I do want to comment a little bit on that big bump up in the late 1990s, early 2000s. And we'll make that a contemporary comment. That has really been associated with the reintroduction of individuals into the asset management, the investment industry. So individuals had, for the most part, been selling individual stocks and going into funds, and they reversed that course. And that created, whenever we see institutions compete with individuals, tends to create a huge amount of opportunity for institutions. And that's precisely what we saw in that period. What we're going through today in the COVID world and the resurgence of retail investors, many of who are operating with very low transaction costs, we're seeing a very similar pattern today. So I suspect that this is going to be not a happy ending for a lot of individual retail investors who are getting into the market for the first time. By the way, this idea, this trend of smaller standard deviation is something that we observe in all different domains. So this is not reserved for investing. This is true for sports. This is true for the world of business, that we call this idea the paradox of skill. And the paradox of skill says invest activities where skill and luck contribute to outcomes. As skill increases, luck can become more important, which doesn't seem like it makes any sense. But the way to think about that is skill has two dimensions. One is absolute skill. And to be clear, absolute skill has probably never been higher than it is today around the world. The second dimension is relative skill, which is the difference between the very best and the average participant. And that we've seen narrow in domain after domain. So in a sense, things become vastly more competitive, and that's how this stuff tends to show up. So with that, okay, we don't want to look at that. So with that, I'll stop. Maybe I'll get rid of my screen. I will get rid of my screen altogether. And I'd be very happy to take questions, comments, corrections, anything along those lines. So Nick, let's open this up and get a dialogue going.
All right, very well. Thank you very much at this early time at your end, but still very energetic, very impressive. Okay, I would start with the first question. In which areas do you still see capital market inefficiencies?
So, I mean, I don't really have very specific recommendations, but I will mention that we wrote a piece which would guide this type of work, and maybe I can animate it a little bit as we go through this. So we wrote a piece a while ago, and if you Google it, you can find it. It was called "Who is on the Other Side?" And it was a large piece talking about the concept of market inefficiencies. And by the way, there are a lot of really interesting concepts in there. But what we ended up laying out is what we call the BAIT framework. So B is behavioral. So these are the sources of inefficiency. B is behavioral. A is analytical. I is informational. And T is technical. So as I think about those four components, probably I would be looking at a couple things. One is the behavioral one. And the behavioral one really says that markets are very efficient when we all operate independently and we're diverse, but markets tend to veer to excesses when we correlate our behaviors. I suspect that in pockets of the market today, I certainly can speak to the United States, maybe less so around the world, that there are pockets certainly of excesses today, and that is fueled by the second component, analytical, which is it is the case that trained investment professionals tend to be better at investing than individuals who are less trained. And as a consequence, you see a lot of the people pouring into these particular stocks or particular ideas tend to be less sophisticated. And so I think, and we've seen this movie many times before, so I think that's an area I would look at. It's difficult sometimes to participate because of friction, arbitrage costs, but those would be the areas I think are interesting to look at. So that's what I would recommend. I recommend that framework. So I don't have any specific ideas, but that is a broad way to think about that problem, and it's a great question.
Super. Thank you. What are your thoughts on news-making prices versus price-making news?
Yeah, so the first thing that comes to mind when I hear that is George Soros's theory of reflexivity. And so the question is something about positive versus negative feedback. So in markets, negative feedback is arbitrage, right? So two assets of same value get pulled out of line for whatever reason, and arbitrage will be the process of buying what's cheap and selling what's dear and bringing those prices back in line. And the idea of arbitrage is really what most investors are really trying to do. They're trying to take things that are away from where they should be and putting them back in some way. Positive feedback is something that pushes the system away from its current equilibrium, and so it can snowball to some degree. So Soros developed this idea of the theory of reflexivity, which says that it can be the case that a stock does well for some particular period of time for whatever reason, it could be lucky or whatever, and then people pile into it, which pushes the stock up itself. And the very fact that the stock goes up creates opportunities for those managers, for example, to raise capital or make acquisitions or what have you. And it becomes this positive feedback that pushes things up. So I think that obviously the world is always a combination of those, but I feel like we're seeing more of these reflexivity situations than we have in the past. I have no investment commentary on anything, but I would just say an example that appears to be going on today, and again, no opinion on this one way or another, but an example certainly would be Tesla. As a company that it would be very difficult to justify today's valuation based solely on fundamentals, but you could see that there's this feedback mechanism that seems to drive the stock. We get these behaviors around, for example, stock splits. We all know that there's no economic driver. There sometimes can be signaling effects with stock splits, but sort of the extraordinary price action on the heels of that stock split announcement seem to be extraordinary. So I think that both, obviously both are relevant, but the latter scenario where this positive feedback takes hold, by the way, this is again an age-old concept. This has been around for a very long time, but we are seeing pockets of that certainly in the markets today. And I think in part fueled by retail investors. I mean, I think retail investors are just not that big to really move things that much, but they've played a role for sure.
Okay, and then another question, what was the big change in investment approach in our industry, or the biggest change? Active, passive, we want it only?
Well, I think that's obviously a very big one. But I'm not sure. I mean, for me, I just think about in my own career, and Nick, you are right. I mean, I've been in this business my whole career since the mid 1980s, and it's interesting that my first job, the security analysts, some of them didn't have computers, literally did not have computers, and they would calculate their earnings estimates based on spreadsheets that they did on a piece of paper, right? So that's hard certainly for younger people. It's almost impossible to envision this, that people are actually, your gross margin's off, you have to erase everything and like rewrite the numbers with your calculator. But that indeed was what was going on. So I think to me, what's happened is just the explosion of information. And as a consequence, and this actually goes to the prior question as well, which is, as an investor, how does one keep focused on the signal versus the noise? Because there's so much coming at you at all the time. So I think the proliferation of information, the incredible access to tools, including computers, and you just think about the cost and computing power of what we can do now. Certainly the introduction, and it'll continue to play a vital role of big data. And then I think the big questions we will look forward to in the future is, and I believe that the best investors will be a combination of systematic technologies, so systematic strategies. So we'll call it more quant. So we'll call it machine, and man plus machine. So humans and introduction of judgment in certain ways. So integration of technology and certain systematic processes, even in a fundamental investment approach, I think will add a lot of value. And by the way, I would also say the other way around, which is human contributions to systematic processes also will make a big difference. By the way, I'll mention really one quick note. I mentioned yesterday we published this thing on intangible investment, and I showed you a number of the outputs of that in the discussion today. But we all know that, for example, value. When I say value investors, I say value people use the value factor have struggled. And the classic value factor, of course, is based on things like price earnings multiples and price to book. And what we know is that those are much more distorted than they used to be, right? Because of the change of the economy. So there's some good evidence that just some modest reflections of intangibles, which would increase earnings and increase book value, actually improve those signals quite meaningfully. So yeah. And by the way, I would just say that if you think back to through your own career, certainly I think about my career, there's a lot of stuff that's happened, right? The crash of '87 was during my career. We obviously seen huge recessions, Great Recession. I mean, there's always something going on, right? Geopolitical concerns. I mean, by the way, if you had asked me when I started this industry, would I ever see 70 basis point 10-year treasury note yield, I would have thought that was crazy. Here we are, negative real rates. I mean, all this stuff seems completely unprecedented. So, and by the way, if someone says interest rates will be 5% in at some point in the next 20 years, that sounds crazy. But you learn to recognize that the world is all probabilistic. So.
Right. And you just mentioned that automation is one of the biggest, or has been a big change factor. And a question linked to that and using time wisely as an analyst. It's a question from Felix Brunot. He said, I read your book, Expectation Investing. Awesome book. I built my own model of reverse engineering DCF. Modeling takes me 10 minutes instead of one day using classical sell-side DCF model. I used to save time to analyze more deeply companies. In your opinion, how long will it take for brokers to implement reverse engineering DCF and spend more time on fundamental analysis rather than on marketing and modeling? So do you agree that 90% of reports from sell-side industry currently deserve to go to the bin?
Yeah, I have mixed feelings about that, having been, as you pointed out, Nick, being an ex-sell-side analyst. I was in that business for a long time. I'll just mention a couple things. The Expectations Investing was a book that I wrote with Rappaport that came out in the fall of 2001. It turned out to be very bad timing, of course, because of the bear market and so on and so forth. Rappaport, who, by the way, is 88 years old and still incredibly active in mind and body, we're actually working on a revised version of Expectations Investing. So we'll see how that unfolds, but that could be out as soon as next year. So probably a 20-year anniversary of that book. So we're working on this. And so this obviously, when you're updating something that's 20 years old, gives you a lot of opportunity to think about, you know, all the things you've learned in the last 2 decades, but also give some pause about like, where are we with this idea? And notwithstanding, I think it's a wonderful question. Notwithstanding that question, I still am shocked at how few people actually rigorously apply this process, because it makes so much sense when you lay it out for people. And yet it's still very underutilized. And I think for the most part, sell-side analysts don't even think about this at all, candidly, is my sense. Is by the way, I should not admit this, but I'll admit it anyway. You know, I spent, as Nick mentioned, I spent, 16 years cumulatively at Credit Suisse. We'll call that mostly on the sell side, and then the balance of my time on the buy side. And every time I've gone from the sell side to the buy side, the first thing I've instructed all my sell side brokers to do is take me off every distribution list. So I get no research whatsoever. And I just ask our other investors on our team, if something's interesting, send it to me, but I don't want to be on these lists for precisely this reason. So I'm not sure that everything should go in the bin, but I try to keep myself a distance from that to some degree. Let me just say, though, that even in Expectations Investing and reverse engineering DCF, there's judgment required, and it does help to have some sense of the industry and the business and the competitive positioning and so on and so forth. So that's not a simple, easy task. But what I do like about that approach, and that was very much embedded in the question, is it appropriately allows you to focus your energy on thinking about, what do I believe from a strategic point of view or from a financial analysis, from my financial analysis, that is different than what the market believes. And I think that's a really very powerful point of emphasis and a very useful point of emphasis. So I don't know if that fully answers the question, but I find, by the way, I do sometimes find sell-side research useful, often for industry, if I want to get up to speed on something quickly, for background and so forth. That can be very helpful. But for very specific recommendations, I think most of you would probably agree, rarely do you ever use the sell side for that type of stuff.
And you just said you're not a big fan of spreadsheet investing or analysis, but could you elaborate on the mentioned skills in the financial industry, investment management? What does it mean for us in the future of this profession? What does it take?
I mean, this is actually a very interesting question, and we actually wrote a report when I was at Credit Suisse. We wrote a report about this called "Form Follows Function," and so I'm going to give you an answer that I think is I'm pretty agnostic about this, but there's a part I feel very strongly about. So the point being that, and this is why the bait model and things like the market inefficiency model is a very important starting point. So you should really ask the question, how do I think I can beat the market or generate excess returns if that is my objective, right? So how about, and now let's just say that there's a continuum from Jim Simons at Renaissance Technology, right, who has, tons of computers and vast amounts of data, and they're trading like crazy, right, to Warren Buffett, who's, sitting back and reading all day and making very few but very large investments and holding them in theory forever. So these are the two, bands, and there's a lot in the middle, and you want to think about where you can add value in the middle. I'll just say my own personal bias as a fundamental investor is that participating in the short part of the market, so trading things a lot and trying to estimate earnings beats and so forth. I think that's a very difficult game, and I think there are a lot of people that are trying to do that. And so I prefer to go out and think about a little bit longer time horizons. So that's the first thing I would just say like, where do we think we can add value, and what about what we're doing does that? And then the next step is to say, let's align our process and to be completely congruent with what we're trying to do, right? So that is everywhere from identifying opportunities to actual investment process to portfolio construction and so forth, to make sure that everything fits. And what I argue is that one of the challenges in the investment industry is what I call lack of congruency, right? So in other words, people say they do one thing or they aspire to do one thing. And if they actually take the lid off the roof and look at what they're doing all day, it's actually quite different than what they say they're doing or what they aspire to do. So the objective is to say, here's a process that we think is going to work. And here's how our activities, our time allocation is completely congruent with that, serving that objective, and to try to deviate as little as possible. So obviously, for example, if you're marketing and trying to communicate what your fund does or whatever, there's always an aspirational component, like what we'd like to do in an ideal world. But I think the objective is, as a professional, is to close the gap as much as possible between what you aspire to do and what you actually do every single day. So that's a long-winded answer. I will add, and I think it's embedded in the question too, that as part of that evaluation of process, you should think very carefully about what can be done systematically versus what needs or requires more judgment. And there are certain things that can be done systematically. One example, which I think is never really caught on, but I still think is really potentially very valuable, is portfolio construction. So in other words, if you know exactly what you're trying to achieve, so you have objectives and you have good inputs in terms of individual securities, and then obviously you're reflecting and understanding and embedding the constraints you might have. So it's inputs, constraints, output. It becomes a mathematical problem, portfolio construction, and that allows you, even if you're not following it, your model perfectly, just to have some benchmark as to understand what your inputs, given your output assumptions and your constraints, what it says you should do. That's, I think, a very healthy exercise to keep you on the intellectual straight and narrow.
Okay, thank you. And then with regards to the rather long-term investments, how important is valuation when investing in single stocks? Is it different for indices or asset allocation?
Yeah, I think it's, and of course, I teach in the value investing program at Columbia Business School. So of course, I always think that valuation is important. Look, to state the obvious, if you're going to hold something for a very, very, very long time, whether you pay up or down, a tiny bit doesn't matter in the long haul. But I think people should always be valuation sensitive. And the point of expectations investing, just to give the punchline of the book, is to say every stock price or every asset price, but every stock price reflects a set of expectations about the future. And what you want to do is buy when those expectations seem too modest and sell when those expectations seem too optimistic. And so valuation is always important. So let me just say a quick comment on markets. There's a large literature on market timing, and there's some sliver of evidence that some people can do that, but for us mortals, like, no one can really time markets. So I would spend very little time projecting markets and all that kind of timing markets. Doesn't seem to be a very, very good idea. Individual securities, I think obviously valuation is quite important. So I would allocate my time there.
Okay, thank you for that. And you just mentioned that there will be updates soon next year. And how about the book More Than You Know? So Thomas Grosser said it's an amazing book and an easy read. Will you update that soon as well?
No, probably not. And thank you for that. But there's a little thread here that I'll just draw out. So More Than You Know is a compilation of essays that I wrote when I was at Credit Suisse. And the original essays were called The Consilient Observer. And Nick, you probably when you read my title, you said read head of Consilient Research, and you probably thought to yourself, what in the world does consilient mean? So it's a word that people have to look up in the dictionary. And so consilient is really the unification of knowledge, which is bringing ideas from different disparate areas to try to inform the thinking. And when I joined Counterpoint Global, our head of the business is Dennis Lynch, and Dennis had finally remembered the Consilient Observer and what is in More Than You Know. So he said, let's call this Consilient Research, and we'll bring this back. So if you read the research that I've been publishing since I've joined Counterpoint Global, you'll see that it's called the Consilient Observer. So we've resurrected the name. So the closest thing you're going to get to updating of More Than You Know is actually reading our research these days. I will say that, you know, much of those essays were written 20 years ago. So there are some ideas that I maybe would update today to some degree, or I think about them slightly differently. But More Than You Know for a certain type of person who thinks a certain type of way, it's a very fun book because it goes all over the place. So no update on that one, but keep tabs on our current work, because hopefully we'll resurrect a lot of those ideas.
And you also mentioned that not walking the talk, so doing something, saying something, but doing something else. Is this something that you have often seen in your career as the frequency increased at, for example, the crisis in 2008 or any other point? And
yeah, I mean,
lastly, sorry, just want to add, what do you think is the reason, in your opinion, to this behavior?
Well, there are lots of, I mean, so sometimes it's just a simple sometimes people just say things and they just don't do them. I'll give you one example is that, you know, in your prospectus for your fund, you often manager will give an indication of how much turnover they expect in their portfolio, and what they actually do is very different than what they say they're going to do. So that's one sort of concrete illustration. But you know, the reasons we deviate are almost always behavioral, right, in some way, shape, or form. And so one example I'll give that I've always found fascinating, it's actually in More Than You Know, is this concept, this work on stress. And this is work done by Robert Sapolsky. I leveraged the research of Robert Sapolsky, who's a neurobiologist and a primatologist at Stanford. And the argument that Sapolsky makes is that when we're very stressed out, we shorten our time horizons. And it makes sense, right? Because part of the stress response is to operate in the here and now and take care of an immediate danger, typically, right? And so we pull in our time horizon. So you might imagine that, and by the way, almost always those are physical threats, certainly historically have been physical threats versus psychological threats. But you might imagine that equipment to deal with stress, which has been so adaptive, obviously, and valuable, when you have something like a stock market decline, triggers the same response, right? And then your time horizon shifts. So there's an example where if I stress you substantially, you may say I'm a long-term oriented investor, but that stress will encourage certain short-term behaviors that would be ultimately deleterious to performance. So that would be a very concrete example. So, and that was even in form and function. That's one of the things I talked about is the importance of the organization. Everybody here knows that, right? So the firm that you work for and the tone that's set and how we do things around here make a big difference in how you can perform. And so that, and by the way, there's some research, and I think this is sort of, I would say this finding is tentative, but the finding was that when you look at fund manager performance, roughly 2/3 was associated with the organization and 1/3 with the individual. So you're not a person within, you know, you're not a person by yourself, you're a person embedded in an organization, and what's going on around you is very important. So Nick, that's also another long-winded answer, but it's this idea that we're social beings. And so things like perturbations from stress or what's going on in our organization will affect how we make our decisions. And that's very important to be mindful of.
Well, I like these long-winded answers. And then to close with, because we have almost reached our time limit, can I ask you about the 3 books to read regarding improving decision-making in the investment process?
Okay, so I'm not sure I was fully prepared for that one, but look, I'd have to start with Danny Kahneman's book, Thinking Fast and Slow. And some people have struggled to get through that book. I find Kahneman to be very actually beautiful writer and very thoughtful. So Thinking Fast and Slow. And Daniel Kahneman to me is, you know, he's obviously the most eminent psychologist probably in the last 50 years, and obviously won the Nobel Prize in economics, even though he's never taught an economics class ever. So that would be the first one. You know, the second one's interesting. I would probably call it, I would probably do judgment. And there's a book called Judgment and Managerial Decision Making. And there are many editions of this. It was originally done by Max Bazerman. The most recent editions are Max Bazerman and Don Moore. And that is probably the best book. So it's actually meant for executives, but I think it's one of the best books that I know for that. The third one I'll mention, I'll give you a bonus one. The third book I'll mention is a book called The Psychology of Intelligence Analysis. The Psychology of Intelligence Analysis by a guy named Hewer, H-E-U-E-R, Richards with an S, Hewer. And by the way, this book you can find for free. It's on the CIA website. So if you just Google The Psychology of Intelligence Analysis, Hewer, you'll find it. Hewer was and it ran intelligence for the Central Intelligence Agency in the United States, and was very interested in how intelligence analysts make decisions. And so this book is almost like Kahneman Tversky meets the CIA, right? So he talks about all the kinds of mistakes. And I think there are a lot of parallels between the intelligence community's activities and what investors do. So that's a third one I would mention. And then the fourth bonus one is in 2021, will be a new book out by Danny Kahneman and Cass Sunstein and Olivier Sibony called Noise. And noise is this idea of non-systematic error, so that, you know, sort of this randomness. And this has been, in the latter part of Kahneman's life, this has been a big part of his work, and actually makes this sort of extraordinary claim that noise may be a bigger factor in poor decision-making in organizations than even bias. So it's not, I think you can pre-order, it's not out yet, but that's one I very much look forward to. I wrote a piece about this earlier this year. If you Google my stuff, you'll find it. But that's the last, that would be my bonus book.
Super, thanks a lot. So we're looking forward to your book next year. And are there any other books in the pipeline?
For me, no. Writing, no, I think so. Well, if there's one thing that after we do expectations investing, if there's one thing, I wrote a piece a few years ago called, well, it was called 30 Years. It was reflections on my 30 years in the investment industry, but it was the 10 attributes of great investors. And it was a very popular piece. And so, of course, my editor has been hounding me to write that up. So that may be something, and that would be along the lines of More Than You Know, sort of the Consilient Observer. It'd be a relatively short book, but packed with very specific and hopefully actionable things for investment managers. Good.
Looking forward. So, Michael, this has been a very engaging session. I think your enthusiasm spilled over to us, over the great ocean. So thanks a lot for this, and also thanks to the attendees for their questions. And thank you very much.
Thank you very much, everybody. Have a great day. Cheers.